AI is growing fast, but a lot of AI companies still can't make money. And that gap is starting to matter. A few months ago, Sam Altman was still talking about pushing AI even further. Bigger models, more users, more reach. From the outside, everything still looks like expansion. But if you look a little closer, something doesn't quite add up. And in this video, we're gonna break down why. Because not every AI company is gonna fail on technology. Some may fail on business. This is where the story shifts from technology to business. And that's much harder to see, especially in a market that still feels this optimistic. When demos look impressive and user numbers keep rising, it's easy to assume things are working. But in many cases, they're not. At first glance, the explanation seems simple. AI is expensive. Training costs money. Inference costs money, which is the cost of generating answers for users after the model is built. Once you serve more users, those costs rise very quickly. So naturally, many people think this is mainly a cost problem. But cost alone doesn't explain what's happening. A business can survive high costs if the revenue is strong enough. The more you look at it, the less complete the cost explanation feels. So the real issue is not just cost, it's revenue. For many AI products, that's where things start to break. People try them. Sometimes they like them. But that doesn't always turn into stable, repeatable income. Because curiosity is not the same as commitment. And usage is not the same as a business. And this is where AI becomes unusually difficult as a business. Because model capabilities are spreading fast. What felt rare a year ago can become normal very quickly. And when that happens, products themselves start to feel more ordinary too. That's why so many AI tools today are starting to feel surprisingly similar. They become easier to compare, easier to replace, and much harder to defend. That weakens differentiation. Once differentiation weakens, pricing becomes harder. If products feel interchangeable, people become less willing to pay premium prices. And once pricing drops, margins get squeezed. Margins simply mean how much profit is left after delivering the product. So even if usage grows, profit can still stay frustratingly far away. And this is where differences between AI businesses start to show. Some companies are closer to a working model. Microsoft, for example, doesn't just sell AI. It adds AI to products people already pay for. That makes monetization clearer. For many standalone AI products, that path is much harder. They still need to prove that usage can become revenue, and that revenue can become profit. And even for someone like Sam Altman, this is no longer just about building better models. It's also about whether growth, pricing, and cost can eventually form a business that really holds. Some AI companies may fail not because the technology is weak, but because the business never really worked. So the real test now is simple. Do people keep paying? Do the numbers still work after the cost? And does this business still make sense once the novelty fades? Those questions are less exciting than model launches, but they matter much more. The AI boom is entering its profit test, and not everyone will survive. AI is not slowing down. But the rules are changing. AI is no longer being sorted by intelligence alone. It's being sorted by economics. And once you see that, you stop looking at AI as just a technology race. You start looking at it as a business filter. Who can really charge? Who can hold margins? Who can turn usage into durable profit? That is the phase AI is entering now. Not just a race to build, a test of who can actually last.